It's Wednesday and you're watching FreightWaves Now. I'm your host Anthony Smith, and coming up, Mike Baudendistel is back with us and he's going to give us a rail intermodal update. But first, we're going to go to the Zach Strickland, the man himself, with a carrier update brought to you by PowerFleet. Stay tuned.
Welcome to your Wednesday carrier update presented by PowerFleet. I'm Zach Strickland, and today we're going to talk about the separation of the reefer and van volumes in the United States right now. We've got a strong, still a continued strong increase in van volumes driving a lot of the freight market right now. Van tender volumes off the charts right now, as high as they've ever been, except for obviously 2018, but way down there underneath that. In the orange line, we've got reefer volumes. Now, the interesting aspect of this is that capacity remains tight for both modes of transportation. So a lot of what the tender volume index measures is that contracted freight volume in the United States. A lot of the spot market activity, as people are rejecting more freight, they go to the spot market and start filling that up with a lot more volume there. So not telling the total picture here on the reefer side, because a lot of these contracted freight volumes are on the spot market, especially over the summertime. Van, however, most of that is contracted freight, so a lot of those van volumes are pretty representative of the overall van market. But reefer volumes still remain a little elevated. They're looking a little slow, considering that we had this huge ramp up and spike in March, making it look a lot smaller than it is relatively on this chart here. But again, reefer volumes still remain relatively strong, especially if you're looking all the way back into November, December. We're well over that, and even back into last year in 2019, we're still showing pretty strong, a good amount of strength on the reefer segment. Let's break it down by tender rejection rates. So van rejection rates remain around 20% right now. Reefer rejections just a skosh above it at 23.5%. Reefer tends to be a lot more volatile than the van side, just because there's less reefer carriers out there, harder to manage those networks consistently. A lot of reefer carriers will haul some of that dry van freight to get back to where they need to be with all that, the specialized niche reefer movements across the United States. They're both going higher though, so this is a good indication that the spot market is still going to be relatively active moving into late July for both modes of transport here. So both very high. You can see, again, reefer rejection rates, even though they're underneath, the volumes are not growing as robustly as van. Reefer rejection rates continue to be higher than van right now. Again, a lot of that activity on the spot market right now, especially over summer, as a lot of that is seasonal demand that's pushing that higher. And again, van volumes, even though we're right on par with where we were in March, reefer rejection rates, not so much. Breaking it down by region, we've got, the West Coast continues to be the strongest region for reefer activity in terms of reefer rejection rates. The Southwest, of course, right there as well. That heartland right around the central part of the country drives a lot of that reefer demand too. But reefer rejection rates moving much higher off the West Coast. Southwest still has the absolute highest reefer rejection rate at 37%, but it's starting to settle down just a little bit. Again, the Southwest region does involve a lot of that heartland activity with a lot of that food and beverage movement right there. But the West Coast, of course, has that infamous produce season that's we're still continuing to see elevated rates on the spot market out of that agricultural movement off the West Coast, as they are having a pretty strong produce season out there. The rest of the country, rates are elevated, keep that in mind. They're just not as elevated as the western half of the country. Looking at the Northeast, it is probably one of the softest markets of the country right now for reefer activity, but still 13.8% tender rejection rate, nothing to sneeze at out there. Southeast, Midwest, hovering right around that 15 to 20% rejection rate area. So looking at some of the larger markets, larger reefer markets across the United States really fast here. We've got Los Angeles leading the way with over a 40% tender rejection rate right now on the out of the Los Angeles, the West Coast market. Fresno right next to it at 35%. Again, two of the stronger produce sections of the country right now, continue to be so. And again, we're seeing them move higher. So again, expect a lot more spot market activity off the West Coast. The other, Atlanta, Milwaukee, Dallas, all kind of moderating, still elevated, but moderating right now, coming down off of a peak. So that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hello and welcome to the Rail Intermodal Update. I'm here with Mike Baudendistel. Mike, what do you have for us today?
So the AAR just put out week 30 rail traffic data this morning, and I think it's safe to say that they're going kind of sideways on rail traffic. On the board here we have total rail carload, so this is everything excluding intermodal units, and you had been seeing quite a bit of improvement there, at least from a very low level. In the past week it just sort of went sideways. It's still down about 17% year over year for total rail traffic. Of course, it's being brought down by coal and metals, but a couple of the components of that had been showing quite a bit of improvement, like motor vehicles and chemicals, took a step back in the last week. So still, it shows the industrial side of the economy is still under a lot of pressure when you look at rail carload volumes. When we go over to intermodal units, this has been sort of the positive story in rail traffic. Really not a lot of degradation anymore year over year. You see in the last week down 3%. That one also did take sort of a step back. That looked almost like it was going to go into positive territory, but sort of going sideways there. I can explain a little bit, why. I think a big part of why intermodal has performed better than the rail carload traffic. Certainly the consumer economy doing better than the industrial economy, and also there was this really big push to get products to market quickly to replenish inventories, and more of the demand has been going to the West Coast. That's advantageous for intermodal because it's just much less competitive with truck. If you're thinking about something from LA to Chicago, intermodal has a clear advantage. If you go to the East Coast, that can be trucked, much more easily. But this is a chart that we have called the intermodal spread, which puts together some different data series. So what we're doing with intermodal spread is we're taking the cost to go from goods from China to Chicago all the way through the Panama Canal, and then intermodal from, say, Savannah to Chicago, and then we're subtracting that from the cost it takes to ship it on the ocean from China to Los Angeles, and then intermodal to Chicago. So it's a trade-off between service and cost. So going through the West Coast is higher service, going through the East Coast is lower cost. And really what we had been seeing on this chart is really there had been much more demand to go through the West Coast for that speed. And so the West Coast had gotten considerably more expensive, but this latest data point in the last week shows that at least it's off of the low. Still much more expensive to ship it through the West Coast, but we're starting to see that gap narrow. On the next chart, really going to explain why that is. So we broke that down into those two components I mentioned. Ocean spread, and you see ocean spread still at its low. It's still not only $560 a container more to go all the way, that 4-week trip to the East Coast versus that 2-week trip to the West Coast. So still at its low level. Intermodal rates have been what have moved. We have a data series in Sonar for intermodal spot rates, and you've seen both of those from the West Coast and from the East Coast to the Chicago, shoot up in response to a tightening truck market, and you've seen that gap start to narrow. So for a period of time, it was really the West Coast rates that shot up first. The East Coast rates have lagged. Now that gap has narrowed, so causing the overall sort of equation of how to ship your goods has narrowed as well.
And with all these goods being shipped, I've heard talks of inventory levels also really kind of hitting their limits. Does this play a factor into anything at all?
Yeah, I mean, that could be a concern just for overall shipments. If inventory levels get too high, that means you don't need to ship a lot of goods. It's also, I think, interesting on some of the trade patterns where you may see a pull forward in the peak season because so many companies were caught with too little inventory earlier in the year with supply chains just being slower. So it seems like some of this goods that they would normally get in the fall, I think they're trying to make sure that doesn't happen again, so trying to get it in place sooner. So inventories are something to watch, and it could have pretty big impacts in terms of future shipments.
Excellent. And any future trends that you're expecting that you're going to be watching closely for?
Yeah, I mean, I think that what happens this fall is going to be pretty interesting. I mean, usually back to school is a huge shopping time. I mean, only some schools are going back, so I think that's going to be something that's muted in terms of just overall sort of dry van and dry van activity. But later in the year, I mean, I think really is sort of pull forward in terms of the peak season. I mean, last year you had a muted peak season. This one you might have even a negative peak season if a lot of this stuff that's coming into the ports comes in ahead of time.
Excellent, Mike. Thank you so much. Insightful as always. And thank you so much for tuning in. That's going to do for this Rail Intermodal update and this Wednesday edition of FreightWaves Now. But as always, you can check us out on all your favorite streaming platforms like Apple TV. Thanks so much for tuning in, and we'll see you on the next episode.